Let me switch gears to returns. So Rob talked about returns, and he's looking at it from the perspective of, over the last year and next year, and this year and next year. What I wanted to look at was something that has a bit of a longer-term time frame. So about 4 months ago in The Economist, they actually published a chart, which looks like this, and it shows, this chart here goes back to 1900, and it shows the expected return in a balanced portfolio for the next decade going forward. So really what it's saying is, back in the late 70s, early 80s, when interest rates were high, based on the fundamentals of the low stock prices and high interest rates, you could expect a 10% compound rate of return for the next decade. Compared to today, 2%, which is as low as it's ever been. Now, who else agrees with this? Well, let's just take a look here. 4 days ago in the Globe and Mail, there was an article with one of the Kim Shannon, one of the better Canadian equity managers, saying that she expects returns to be extremely challenged over the next decade. The same time this morning in the paper, this is Michael Sabia, who's the chairman of Caisse de Dépôt in Quebec, the second largest pension plan in Canada. They have $250 billion of assets, and he's saying exactly the same thing. They expect volatility and modest returns and anemic growth as the framework in which they're trying to make investment decisions. So in other words, it's a bit like running uphill or basically rowing upstream. It's going to be challenging, no easy pickings. So the question is, in a balanced portfolio over the last roughly 100 years, you could have reasonably expected to earn a 4% real rate of return after inflation and expenses. The question is that going to happen in the future? Well, before we look at that, in the future, we should talk about how it has occurred in the past. Because this issue of people saying that future returns are going to be poor has been that way for quite a while. So this is something from a website called Portfolio Yoga. And their view is they're educating people about how they should invest their money. So if you're conservative, you're 50% in stocks, 50% bonds. If you're mid-risk, you go to 60% stocks. And if you're aggressive, you go 75% stocks. And God forbid that any other asset class should ever fit in here. So let's take a look at what the last 15 years, 16 years has been like. Is this the right model? Was it the right model? What are the returns for the last, since 2000 basically? Well, they were 2.3% net of inflation for the conservative investor, 2.1 for the mid-risk investor, and 1.8, so taking extra risk didn't help for the aggressive investor. So in other words, while people are talking about low returns going forward, the fact is we've gone through 16 years in traditional portfolios of a very anemic returns. So really, all they're saying is it's basically more of the same. So as you know, we have a model, and David went through it briefly, which is meant to be more diversified, and it's really focusing on cash flow. And the real question is, does this make a difference? Historically, does it make a difference, and is it likely to going forward? So let's take a look at what we're looking at from a shorter term perspective in the last time frame. So David talked about returns since 2000 being 4.4% before inflation for a balanced portfolio, and our portfolio in the same period of time, 7.2. And that number would also apply to a lot of organizations he referred to that invest with a similar asset mix. How has it been in the last little while, like in the 14 months leading up to February of 2016? A balanced portfolio is at 0.75%. Our clients on average netted 5.8% after fees in the same time frame. So what this says, and we've gone through this historically to take a look at good and bad markets. Generally speaking, the kind of portfolio we recommend manages to keep pace with a traditional balanced portfolio quite well in bull markets where things are going pretty well. It significantly outperforms them in bear markets or in cyclical sideways markets, which is what has been occurring roughly over the last year and a bit. Okay, so let's take a look though, even within what we do, there's always winners and losers. So this is actually a chart. The losers are in red and the winners are in green. This is for the last year, for the calendar year 2015. So on a weighted basis, the average return of the losers last year for us was 7.5%, minus 7.5%, whereas the winners were up 11.4%. And when you weight them for the total amount of money in each asset class, it comes up to a blended return for most clients of 7.48% for the calendar year 2015. So the key is this, that we need to have the discipline to say, fine, every 3 months, we don't really wait till the year is over, we need to take money from the winners and we need to give it to the losers. And this is the hardest thing that people can do in investments. It's really difficult for you to say, I've just got this asset class. We're going to look at a couple of them, but let's say it's preferred shares, and they're down 25 or 30%. So let me get this right. You want me to buy more of them. I mean, have you, and of course, once I say that, they realize that there is a connection between me and Pooh Bear in terms of the dim-witted side of the discussion. So the challenge is to say, why would you want to buy something that, as far as you're concerned, is losing money? But that, interestingly, is how you get better risk-adjusted long-term returns. You buy something that has a lower cost. So let's take a look at how it looks when we're looking at catching a falling knife, or take a look what happened to the worst asset class in the last year, preferred shares. So they started the year at about $11, $11.70 a share for our pools. It dropped by almost the middle of the year to $10.34, so almost 10%. It kept falling, and it didn't bottom until the end of February, early March of this year. And at the same time that was going on, the yield on the shares was going up, because the yield is the inverse of the price. So by the end of the year, the yield was then 6%. Now, why did this happen? Two fundamental reasons. The first was, a lot of these preferred shares were issued with higher dividend rates, and the issuers of them were allowed to renew them at lower rates because it came due every 5 years. They could be reset every 5 years. So that was going to be the intention. 5-year bond rates were lower, they could reset the rates at a lower rate. The market didn't like that, so discounted the value of the preferred shares, effectively forcing the yield back up. That was compounded by the fact that the banks in Canada had to raise Tier 1 capital and went to market with very, very high dividend rates on their new preferred shares, in some cases over 5%. So those two things created the perfect storm for an asset class that is far less risky than common shares. So they underperformed common shares by a very big margin. So prices were down 35%, but the yields were up 50%. And there's also 20% less tax on preferred shares than there is, say, on a bond. So effectively, as of the end of February, the effective pre-tax yield on a preferred share was in the 8% range, which is a phenomenal yield in this environment. And in addition, there's a very good chance of capital recovery in the next 5 years. In other words, the market loss of price has a very reasonable chance of recovery in that 5-year time frame, depending on what happens to interest rates. So let's look at another category, high-yield bonds. Now, high-yield bonds didn't lose money last year, but they had a really poor last 6 or 7 months of the year through to the end of February. And in fact, they dropped in price by about 15%. Now, this happens to be my personal account, and these are interest-bearing bonds. They pay interest on a monthly basis. So that money is reinvested every month, which is a form of dollar cost averaging. So I'm buying more new bonds at lower prices in February than I was in July. It's an interesting form of forced investment management. The income each year or each month is being used to buy more shares, and it forces me to buy more shares the lower the price goes. Now, over the last 6 or 7 years, this account has earned about a 6.2% rate of return, which I'm very happy with. I mean, it's a fixed income bond rate of return. And the current yield was 7.5%, it's a little over 7% as of the beginning of this month.